What's going on, everyone? My name is Nicholas Merton here at Data and today is January 13th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about what may be one of the most important topics of our time for those of us who are millennials or those of us who are a part of Gen Z, and it has to do with the topic of wealth inequality. Now, before we dive into this, I want to make something very clear. This is not only not a video railing on free market capitalism, I'm a big free markets guy personally, but along with that as well, this is not a jab at people who have maybe a little bit more wealth than others. I can tell you all, for my age group, I'm very well off, and along with that, comparing myself as a US citizen to someone else in a different country, I'm living much better off than most people across the world, and I'm very thankful for that. I'm not here to jab at any of those. I'm here to talk about the underlying root problem that has stemmed wealth inequality, not only here in the United States, but abroad across the world. And it's actually much more simple than you might think. It doesn't have to do with free markets. It has to do with monetary policy. And we're going to talk about how Bitcoin can serve as a solution for this key issue. And along with that as well, towards the end of the video, we're going to have a sponsored interview with Gus from Perpetual Assets. So stay tuned for that. It kind of plays into the whole theme here of what we're going to be talking about. All right, so let's go ahead here. We obviously know Bitcoin is an asset over the long term here, has performed very well as an asset. It's continued to set higher lows here. We're just taking a look at the Coinbase chart here. But if we take a look at BLX, which is kind of the aggregated index for Bitcoin over time, Bitcoin has consistently over a longer time frame set higher lows and higher highs, and has really been setting into a logarithmic channel here where it's had exponential gains over a long period of time. But there's an important topic that I think this plays a role into here, and that's the issue of wealth inequality. Now, Bill Gates and many billionaires, ironically enough, are the ones that are really kind of heading up this discussion because they probably see it more than anyone. Seeing their net worth go up tens of billions of dollars every single year, okay, maybe not every single year, but over the course of the last decade or so, we've had a major growth of new billionaires in the economy, not just here in the United States, but across the world, and really kind of a diminution of the middle class at the same time. And people like Bill Gates, whether, again, they have good intentions or not and stuff, there's all kinds of different billionaires who want to see wealth inequality reduced, some who don't. They have been talking about this wealth gap. And many of them will always refer to the fact that there needs to be reform in the tax system in the United States. They say that, they're not paying enough taxes in this case, that they've been disproportionately rewarded for the work they've done. And because of that, they should be owing more to the government in this case. Now, again, we could debate about tax policy in the United States. We could talk about, wealthier people, like a progressive tax system, or having, for example, flat fair tax, as some people, recommend, where everyone just pays the same, 10 or 15%. But the thing about this is that it's so surface level. As much as I do admire these kind of comments from these billionaire figures who are saying they want to pay more in taxes, which is kind of ironic because they could write a check to the government whenever they want, but they won't. I don't think they want to toss money to the government because they understand that in many cases they might, waste that money, right? And not to mention, I think in many cases, a lot of billionaires say things, but they'll do another thing, right? They'll keep the same tax laws in place that benefit them. We have to get down to the root cause of why this has happened. It's not just simply a failed tax policy. Why is it that the cash flowed up to the top in the first place to lead to this divergence? That's the key question. And it has a lot to do with what we care about, and that is monetary policy. So let's go ahead and just take a look at a few charts here just to get an understanding here as a precursor. We can see here generationally, if we take a look at older generations from 65 to 75, we can see an over 12 times gap from where millennials are sitting right now, from those of us who are from 25 to 35 right now. Now, bear in mind, it's important to understand that if this is taking the same exact wealth during this time period, right, it's understandable in this case that it's going to be a little bit higher, right? As you grow older, you tend to have a higher net worth. But again, even closing in on some of this gap here, it's a stark difference here of the position of where these two generations are right now. Along with that as well, taking a look at where the bottom 90% are in the sense of the wealth that they hold, less than 25% of the country's wealth here, pushing very close here to 23 or 24%. We can see the top 1% outpacing the next 9% that own a little bit over 36 to 37%. So this is a chart here from 2016. This has actually continued to cross and grow larger over time as well. And you can also see the distribution of family wealth here. This chart, I think, really puts it in perspective. I'll go ahead and zoom out so my webcam doesn't get in the way. You can just see here the kind of proportion of growth and wealth here over time for those who are in kind of the top 1 to 2 to 3% of brackets for wealth. And this is a really good chart and system from the Wall Street Journal. This is my favorite chart because it stacks the wealth here. Now, as we scroll through here, it's going to highlight different portions here. But we can see here, these are the 3 different categories, or excuse me, the 4 different categories. The bottom 50% barely shows up. The bottom half of America barely showing up at around maybe 3-4%. I wouldn't even give that 2 or 3% here on the chart. The next 40% owning about 20% of the country's wealth. The next 9% owning pretty much what the bottom 40% or the bottom 90% own. And then the top 1% having its own bracket. So this is just incredibly, visual perspective into what's going on, guys. And I mean, we go through the charts here, we can see it, but I want to go ahead and talk about what really has caused this. Why is Bitcoin the tool for this? The issue itself is monetary policy. Now, you can look at pretty much any single data point. You could look at tax policy. You could look at, expenditures. You could look at all kinds of different economic pinpoints that might play a role into this issue. But there is nothing more relevant than inflation and devaluation. If we take a look here, we can see the devaluation of the purchasing power of the dollar here over a long period of history. And a lot of it has stemmed from back during the creation of the Fed. There's a lot of events that play a role into this over time. But the key issue here to really take into mind, guys, is the excess printing of money. That anytime we hit a recession, anytime there's a pullback in the financial system, in the global economy, we decide to inject cash. We decide to destroy the purchasing power of the underlying currency. Because a lot of that money, that new created currency that dilutes the current existing purchasing power of dollars, is issued and ends up flowing back into the same corporate system, into the same financial system where asset prices go up, right? Stocks go up over time. And we have to ask ourselves a simple question. Who owns all the assets? Who owns all the properties, the stocks, the treasuries? The vast majority of it is owned by wealthier investors, right? It's not a lie or anything that's like overtly critical. It's just the reality. And if you're not holding those assets like the vast majority of Americans, then you're not going to benefit. And this is why Bitcoin serves as a great hedge. It's not only a great hedge against inflation, but along with that as well, with its fixed monetary supply and being a new emerging asset, this could give an opportunity for a lot of individuals across the world to have the ability to opt out of the devaluation of the dollar in this case, the long-term loss of the purchasing power of the dollar. This is an interesting chart too, just to kind of put it in perspective from back in 1950 down here to where we are now. The absolute loss of purchasing power compared to gold. And bear in mind, gold and Bitcoin are not yielding assets. They don't produce anything. To be fair, at the end of the day, they only provide a hedge against the devaluation of the dollar. And even this alone showcases the benefit of being able to put your dollars in gold here, because it's a hedge against the devaluation of your purchasing power in dollars. Now, if we take a look at this chart here, right, I want to go ahead and again just kind of summarize it here to kind of prove my thesis, right? If we take a look here at this chart, we can see similarities to back of what happened back in the 20s and 30s. Notice here where the top 0.1% of individuals in the United States when it comes to wealth held nearly about 20% of the wealth here, as we do today, right? And this past decade, as we step into 2020 here, it'd be interesting to get some updates on the data, but sadly we don't have all the charts, right? It's hovering around this range here, though. We can see the bottom 90%, again, going back down towards a similar range here. Well, what led us to this percentage range for the top 0.1% of income makers in the United States back here in the 20s and 30s? Well, if you take a look back at history, we were going through a very similar phase of what we've been going through for the last decade. And that was the fact that the Federal Reserve, which was invented in 1913, was excessively printing money. And not to mention as well, there was all kinds of regulations in place to benefit asset markets. These two things propagated an asset bubble where a very select few were exposed to assets and therefore led to a massive wealth divergence. This is the key issue. It wasn't because we weren't taxing them enough. It wasn't because, there wasn't enough government intervention. It was because the money wasn't sound. The simple monetary policy that dictated the economy led assets to going up and enriched a very select few people. That's the key issue. It's no more complex than that. There is a few other minor things that might change up, but that is the secret sauce, guys. That is the reason since back here during the 80s, since we broke off of the gold standard in the late 70s, that is why we have seen the loss of not only purchasing power for the average American, but the loss of wealth in this case. The destruction of the middle class. It is no more complex than this. And this is another chart to just showcase that. We can see here the divergence. The two things that really matter here is whether or not Americans are investing, and along with that, during periods of time where Americans are not investing, but we have excessive monetary policy changes. So we can see here, for example, the top 0.1%, this is another way of looking at it. You can see here had peaked out, in this case, back here, over the bottom 90% of Americans right before the stock market crash in this case. This was the roaring 20s. Again, the excessive monetary policy. And afterwards, as we stepped into the war here, and 2.2 million veterans had taken advantage of the GI Bill in this case, you started to have a huge boom here afterwards, post-war and post-recession boom. And you started to see, generally speaking, the poor and the middle class really start to get some ground here in the sense of wealth. But now, again, as we stepped into the last decade, we've seen that cross here. And again, it's a repeat of history here. It's a boom of the asset markets, devaluation of the purchasing power of the dollar. And again, the other thing to take into mind is we've talked about here on the channel, in equity markets, all of the cash that corporations have brought in, instead of investing in new factories and real economic development and paying higher salaries and research and development, it has gone into an asset bubble. An average of around, over the last few years, over $1 trillion of easy money going into dividends, to investment, to those who are holding equities. Over $1 trillion as well in combination with not only dividends, but also with stock buybacks that are literally just propping up the price of assets. So we have two issues on our hands. Americans are not invested in asset classes. And along with that as well, the monetary policy is not benefiting those who are not in asset classes. So what is that solution? I think it's a new emerging asset like Bitcoin. I think it's an emerging asset that is a fixed monetary supply. So not only for those who simply just want to save their wealth and simply hedge against dollar devaluation can put their wealth in it, but along with that as well, for those who simply might want to speculate or have an asset that can grow in the long term. It's so funny because I think a lot of people are worried about Bitcoin because they see the volatile swings in Bitcoin and they think, oh my God, I can imagine putting my money in Bitcoin because tomorrow it might be down 20% or it might be up 100%, right? And they can say that with a straight face because, they're focusing on the short-term moves. And it's not something I'm not meaning to judge here, but I think it's a short-sighted issue with so many people is that we look at what's going on in the day-to-day, but if you notice that Bitcoin sets longer-term higher lows and longer-term higher highs, then you're good. That's what a good performing asset should do. And Bitcoin was the best performing asset over the last decade because it's a new emerging store of value. It beats out gold. And that chart there shows the inflation rate of each given asset, the stock of available gold here in metric tons versus Bitcoin. And this is on a much shorter time frame where we're going to be by the next decade reaching to the point where there's practically there's practically not going to be much new Bitcoin being mined. It's going to be reaching it's pretty much near its maximum supply at 21 million, whereas gold consistently has a 1 to 2% inflation rate. It's your call on which one's a better hedge. In my opinion, I'll take the one that has an absolute fixed supply in this case. All right. So anyways, that's it for the video, everyone. I hope you all enjoyed this video. If you did, drop a like down below. If you got something to say, whether you agree with me or disagree, leave a comment down below. Let me know your thoughts on it. But again, I truly believe that Bitcoin is an emerging asset in this case. It's the reason why I'm massively exposed to cryptocurrencies, because I not only believe it's an emerging asset, meaning that it's going to have excessive growth over the next few years, in my personal opinion, but along with that, it serves as that hedge at its baseline against the devaluation of the dollar. Right. So that's what I'm looking forward to over the next decade. I'm interested to hear what you guys are thinking about over the next decade as well. So leave a comment down below. So let's go ahead and dive into our interview with Perpetual Assets. Alrighty, everyone. So in today's sponsored interview, I'm sitting down with Gus DeMoss, who is the managing partner and co-founder of Perpetual Assets, which aims to help individuals set up their own LLC IRA, which is a specific investment account that can help you get exposure to cryptocurrencies and a variety of other different types of emerging assets. So, Gus, thank you very much for making the time, man. It's great to see you since we last met back in Vegas in October, and we've been keeping in communication for a while. But before we dive into any of the kind of technical aspects of it, I definitely want to give you some room to talk about what you guys do at Perpetual Assets and why LLC IRAs are so interesting.
Thanks for having me on, and yes, good to see you again. Looking forward to Vegas next year, and we'll be at the North American Bitcoin Conference next week, actually in Miami as well. Not to give them a plug, but so be it.
Yeah.
We've been in crypto or LLC IRAs for years and years, and what we offer specifically is clients who want to run and have complete control and flexibility of their retirement account, their IRA. Specifically, it allows you to invest in almost anything and work with crypto, but it also works for a range of other assets. So it gives clients the full ability to run the thing. And I don't know if you want me to dive right into the technicalities of it, or what we value is clients having control of the keys, being able to swap in and out of assets or have numerous assets, including crypto and metals. We also offer metals as well, or many of our clients gravitate towards metals. But client control and flexibility has always been our motto in regards to our retirement account structure.
Yeah, I think it's important to dive a little more into kind of the structure, because I think LLC IRAs are so fascinating in the sense that, unlike a lot of the other IRA systems in the cryptocurrency space, I've been eager to see this kind of come out of the financial sector for a while. Most of them usually berate you with not only fees, but along with that, you don't get to have self-ownership of your assets. And I think that's something that's really cool about you guys, is that you've really pursued making it easy to have this LLC structure for an IRA and be able to have full advantage of kind of being your own money manager in this case.
That's a great way of saying it. And some might say, oh, it's like a little mini hedge fund or a little mini asset management firm or holding firm. So when the majority of people out there hear crypto IRA, there's other companies out there doing some sort of deviated version of that. What's technically occurring is this financial institution, this administrator, is buying cryptos directly for you. So what the differentiator, what makes us way different from those other companies, is three main factors. The administrator for what we do isn't buying cryptocurrency directly. What the administrator is buying for your is this LLC, this management firm, this little hedge fund, whatever you want to call it, and you, the user, the client, is running the LLC. You're in total control of it. The difference between us and a lot of those other guys out there is, under our program, you could buy crypto, you could buy metal, you could buy stocks, you could buy bonds. Total flexibility. Those other guys pigeonhole you to just that asset class. Even more importantly, in my mind, is those other guys, you aren't holding the private keys. Those keys are held somewhere else. Go ask them if you're going to get those keys. No. Under our program, the LLC, the little holding firm, holds on to those keys. So the client has complete access, complete control to the assets. And in the crypto space specifically, it's those keys. On top of that, if the client buys crypto from us, which we hope we earn that business, they're not obligated to. The LLC is a service. We structure this IRA for you, get it up and running, and then you're free to buy crypto, metal. Like I said, we also happen to sell crypto and metal, but you're not even obligated to buy it from us. We hope we earn that business, or separate transactions. On top of what I said are the indicators, the keys, and what's technically occurring, and flexibility, we undercut them on price by whatever, 60%, 70%, 80%. Their fees are enormous. So we have those are the differences with them. In regards to the client, the flexibility, like I said, they could invest in almost anything or numerous things at once, or leave the cash sitting there collecting dust in the bank. But it's our goal for a long time was get clients running their own thing. Give them total. No one cares for your net worth much as you do. So it comes with a certain level of accountability, but you're running the thing, good or bad.
Yeah, I guess I think building onto that point and stuff to get a kind of service level view here, you guys offer the structuring service of being able to formulate one of these LLC IRAs to just make it simple. You don't have to go through, as a user, I'm not having to go through any complexity in that case to set this up. So it's like setting up an account through other services like exchanges and things of that sort. And then along with that, you guys also offer the business of being able to provide the exchange service to be able to get exposure to asset classes like Bitcoin or other cryptocurrencies or gold and silver.
Perfectly well said. We've been doing, and I don't want to. We could talk about the history later, but we've been doing these things for 8 years. Mm-hmm. What we just started offering recently is the crypto. The last year and a half. We always did metals and IRAs, but the crypto we got in the last year and a half because, like I said, we have competitive advantages against the other crypto IRAs out there. Those are easy to point out. Why we got into this game the last year and a half about selling cryptos directly to these LLCs is our competitive advantage on the exchanges we weren't aware of until a year and a half ago. What occurred is our clients that we sold this service to, the retirement account, were going to the exchanges trying to buy crypto. Like, hey, we have this retirement account, we could buy crypto with it. The problem is our competitive advantage against the exchanges, we didn't realize we had it, but we ended up having it, was the onboarding process, the compliance, KYC, AML, the onboarding process. They treat the clients with $5 the same way they treat the clients with $50,000 in a retirement account, which means the onboarding process might take months or weeks or whatever. And even after you get on board, you might have to get ramped up. Oh, $1,000 for 2 weeks, then we'll ramp you to $4,000. So they're so concerned about scaling that everyone gets treated the same, and that's fine. I'm not here to ridicule anyone else's model. It just we carved out our niche. Like if you're already a client, and even if you're not a client and you're trying to buy crypto from us, we could onboard you in 24 to 48 hours. Right. You're always dealing with the real person. It's white glove service. It's premium service. It's like you always got one of the owners or an employee. Like there's no chat room. There's no call us up. Someone will onboard you immediately.
I think
done.
That's the cool thing is I think it's a combination of you guys having great customer service, always having someone on the line. That already makes leaps of difference. But also when you're dealing with someone who's going under an LLC IRA, it's like a match made in heaven where you can get the ball rolling much quicker from having no exposure to these assets or no direct control over your investments to a full portfolio in a matter of less than 24 hours. So that's a very exciting kind of combination that I think you guys offer as a big benefit to especially larger scale investors. And as you mentioned, as much as I think we want to make sure everyone can invest in crypto, if you're going through the same structure as a retail investor, regulators are going through so much more pressure in this case, or companies like Coinbase are going through much more regulatory pressure. But I think this is an amazing match made in heaven, man.
We will never try to carve out a niche where the exchanges have carved out that scalability. The validity of them, who could argue? They've been around for years now, and that's fantastic. But retirement accounts are typically always larger, and we definitely have carved and I could argue till I'm blue in the face against competitors of, well, what if my client wants to liquidate out of Ethereum and buy Apple stock? What if my client wants to liquidate out of that and buy and we're talking about specific retirement account funds. The flexibility argument and differentiator is so easy for someone to grasp, along with control, meaning how many, and I won't mention them by names, but if you've been in this space long enough, how many coins have we seen vanish at this point? How many more Madoff type scenarios do we have to? People feel really warm and fuzzy knowing, I could go look at that key anytime I feel like it. I could verify the balance. The control and access to the keys is a huge thing that clients come to us for. They're like, yeah, I don't really know these. I want to hold the keys myself. And like I said, in that space, the crypto IRA space, they know the onboarding exchange is difficult for the exchange with the exchanges. That's how they rationalize those fees. So me and you've talked offline. You're like, yeah, I did some research, and God, that seems pretty expensive for what those premiums are pretty high. It's like, well, they knew they were the only game in town, and that's how they rationalized those. We're talking 20%, 15% on some of those exchange. It's like, yeah, that's a hard pill to swallow. Maybe on a bull market like 2017, people didn't care.
So they just wanted to get in. That's the issue and stuff, is people just want that exposure so quickly.
Our greatest struggle as a company is our solution. We've always viewed it as far superior, but it's got a lot of moving parts. It's got complexity. So you're starting this LLC, and the LLC is owned by your retirement account, and you're running it, and so it's a bit more complicated. It's got more. Well, it's not complicated. We handle all the heavy lifting. We've tried to make it as turnkey as possible for the client, but being able to articulate the differentiators in a catchphrase or a sentence is different. That's why we've tried to, from a branding standpoint, we've tried to revert to, listen, we do crypto IRAs, and here's why, and then we could go off the back end of that. But there are a lot of differences between us and the other players out there.
Yeah. Well, to build on what you said, Gus, and stuff, you were hinting earlier and stuff as we've talked and we got to meet each other in Vegas. I mean, you've been in this space since back, if I'm correct, back in like 2011, 2012. You've been in this space for a very long time. And you've not only seen crypto evolve over time, but I mean, you've taken all that kind of experience of seeing the bottlenecks in the space and been able to put it into your company and build a system that's much more efficient in this case, using the current regulatory landscape that we have, which is not easy to work with, to put it simple.
Yeah, that was our. So I'll give you 2-3 minutes of history, and then I'll dive into the compliance and regulation portion of the conversation. We've been in retirement accounts and metal since 2012. So we've been doing this a long time. And crypto, that's when we started hearing about crypto. And I was a much younger man then, and I started interviewing Professor Selgin he was very early on it, and a lot of the Austrians and the academic community got into it. So we dove in. I told you the first crypto conference we went to was the Texas Bitcoin Conference in 2013. But we were tracking before that. I was interviewing Jeffrey Tucker about it, and other individuals very early on in the game. So we started accepting it as a company, like through a payment processor. We took crypto for metals or for retirement accounts or for whatever. So that's very early on in the game. And then our clients started buying crypto using we have for this retirement account vehicle, this LLC IRA, and our clients were usually 100% to metal, crypto, and the flexibility of having both and the control. The bottlenecks we saw when we decided we're going to become crypto dealers ourselves. That was based on the 2017 bull market, not the part most people would default to, which is 100x, 50x. Yes, that part, but the compliance and regulatory bottlenecks that occurred in that time span. What occurred behind the scenes with the exchanges, and you could talk to users about it. It took me 3 months to open up. What occurred is madness. They were trying to onboard all these people for all this compliant. The market was going in a linear fashion post Mt. Gox to 2017. It was going linear. It was going nice and slow. The exchanges could handle the onboarding, et cetera. And the government, both the feds and the state were coming in, and here are the parameters. Here's the KYC stuff. What occurred in 2017 is the onboarding compliance madness. The exchanges were pulling their hair out trying to keep up with all these users, and the clients were pulling their hair out trying to buy crypto. The bottlenecks are at two places. It's fiat to crypto to fiat. Once you're in crypto, you could find numerous areas to trade. That part's easy. So the regulation is still lax, crypto to crypto exchanges. But if you want USD to crypto or crypto to USD, that's where the regulators are at. And the exchanges are handcuffed by them. And the exchanges are, everyone's a number. Let's churn out as much volume as we can. Again, the customer service is the same as the guy with $5 versus the guy with 5 million. And that's where we carved out our niche. That's where a light bulb went off and said, listen, we're ready. We're doing retirement accounts. I already know who these people are. This isn't Pablo Escobar and bin Laden. I have their retirement account. we've been structuring this retirement account for weeks. I know who it is. And so our onboarding process for KYC and AML was 99% done before the client, like we already had all that. So we're like, let's get these people on board quick. We carved out a nice niche based on speed and convenience. You're always going to be dealing with a live person. You're not going to be dealing with nonsense chat room. We'll get you on in a day or two. Doesn't matter. The guy with $5 million is getting on board in a day. Doesn't matter. So that was our niche, and that's what we pounced on. What we saw, what we see in the field, and me and you talked about this offline, is the madness occurs during the bull market. That's when the phone really, really rings. What occurs in the bear markets is the phone there's not as much volume there, but that's when the smart money comes in. That's when the big money comes in. It's like, okay, the madness is over, and now you drop 40%, 60%. Now I'll take my piece. Thank you. So, and offline, we've talked about the housing bubble, the dot-com bubble. We saw it all, right? So the internet didn't go away after the dot-com bubble. It's a matter of fact that it defined the next 20 years. It's just that, madness occurs and retail investors come in. That's fine. But the smart money usually pops in, what we've observed firsthand. And the same thing happened in metals and when gold hit 19 and silver hit $50. And so I've seen it firsthand in the dot-com in housing. Dot-com, I was a student. Housing, I wasn't in the field. I was at software at the time. But metals and crypto, I've been at the front lines, observing both for the last 10 years. And I've got to see both run-ups, and it's fascinating. It's very fascinating how it works. People go with the crowd, and those animal instincts take over, and everyone wants to 10x or 100x, and then Bitcoin hasn't gone away.
Yeah.
Now that the market has cooled down, friends still are like, "Oh, is that Bitcoin thing still around?" I'm like, "It's like eight grand." Yeah, it's still like.
Well, I think to build on that point, Gus, you were talking about the internet and stuff, the dot-com bubble, where we had the biggest, I think, tech stock run up in history, and then after that, we had an 80 to 90% correction, and over the next decade, really over the next decade to 2 decades, we had one of the best bull markets in history for tech stocks. If you picked around that bottom, you not only got to ride out the dot-com bubble yet again, you got to ride the next wave that has been continuing in the NASDAQ. And that's the same thing I think we're going to see with crypto. We're going to see cyclical processes where you have sharp corrections, and during the times where there's no interest or absolute fear in the market, that's the time to get bullish, or at least see potential in the future in this case, or at least that's when the smart money comes in. But
we talked a little bit earlier about philosophy and the rest of it before we went live. And one thing I've been saying pretty early in the game, 2015, 2016, I've been saying for going on 5 years now, it's this thing is here to stay. I just can't tell you who the winners are going to be. Mm-hmm. It's like, so, and I gave a speech a couple of years ago during the 1,000, it was at Anarchapulco, and I think it was like 2017, and it was 1,000 had just been breached. This is before 20K happened. This is early 2017, like January. The conference was like first week of February. It was like Bitcoin was at like 1,100, and I went up there and I said, "Listen, crypto's here to stay. I just don't know if you're investing in MySpace or Facebook." Like that, and that's where me and you start talking about use cases and et cetera. Crypto's not going anywhere. I just don't know what it's going to look like in 10 years. No one does. I mean, it could look like anything. But the technology, when you got the banks adopting it, it's like it's not going anywhere. That's when my friends that I grew up with that still are holding off or making fun of me 7 years later. It's like, I've said, and this is a hand of God, I've said we've had to endure 2 years of some strict compliance training, and the rest of it is me and my business partner, we've sat in rooms with compliance officing bankers and federal crimes unit division and blah, 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 where I've had people who work for the government forecast that the SWIFT system will not exist in 5 years. They said that we can't deny the technology anymore. The bankers love Ripple or whatever. It's like, so it's there when you have regulators and banking compliance departments tell you, yeah, they're saying SWIFT's not going to be around. It's going blockchain.
That's
incredible. It's like it's here to stay. hand of God, it happened. This was 6 months ago. We looked at each other and we're like, did you just hear that too? Like, these are government officials telling you, like, yeah, it's not going anywhere. We're gonna start adopting it. Like, it's like, okay, well, thanks for that. I feel better now.
That's a cool macro
So yeah,
perspective on it, Gus, just to kind of see the bigger picture and to think about, when you start to see the actual regulators or people who are heading up old traditional systems or banks starting to realize that this is the future, that this tech isn't going away. It's the point I always bring about Bitcoin. I mean, these tokens, this system, this kind of permissionless natured, ecosystem of technology is going to change the game whether banks want it or not. And it's a fascinating one, I think, that we're all a part of in this case. To have some ability to easily get access to investing in that space or be able to have exposure outside of just precious metals and other investment classes, I think is extremely valuable. And one thing I wanted to just mention as well, for those who may be interested in perpetual assets, where should they go in this case to learn about setting up an LLC IRA in this case? I know again, for many people, I think that term itself might seem a bit overwhelming, but you guys walk through the whole process, right?
yeah, and that's why sometimes when I'm conducting an interview or speaking, I'll divert to crypto IRA. I'll try to know your audience. So I say crypto IRA a lot because it's like, yeah, listen. If we're on a crypto channel and you're trying to put crypto in your IRA, call me.
Right.
But yeah, go to our. Technically, yes, it's called an LLC IRA because what the IRA is buying is an LLC, and we go to our website, perpetualassets.com. Drop it in your URL. Drop it in your browser, whatever it is. Perpetualassets.com. The LLC IRA, you could see the solutions at the top. The LLC IRA is a service. Lays out numerous crypto examples on there. We also have a crypto tab and metals tabs, etc. But yeah, some diligence is required from the user because it's something unique. It takes some getting used to actually conceptually grasp, like, wait, my retirement account is buying a firm, an LLC, and I run the firm. It's like, that's exactly what's saying. Yeah, and then the firm buys crypto or metals or equities or commodity, and you're running it in and out of assets as you see fit. But we give you this nice package, and all you got to do is turn the key. So we take care of all the heavy lifting, and yes, it requires we have flowcharts, explanation videos, content. You can do as much research as you need.
Well, guys, I think it's a fascinating structure, and I think it provides a ton of freedom. So I'm excited to see you guys continue to scale out. And for those of you who are interested, I'll leave a link down below in the description so you guys can check out Perpetual Assets, check out some of the diagrams that Gus had mentioned and stuff. But Gus, I got to say, it's been a really interesting conversation. It's been great to catch up since we met back in Vegas. And I really wish you guys all the best. I think you guys are providing a very valuable financial solution for people, in this case, to be able to invest in the assets that they want and take control over their finances, which is kind of what crypto is all about in the end. So thank you, man. I really appreciate taking the time.
We appreciate the time and having us on, and it's, like I said, it's been a pleasure, and keep up the great work. I've been, even before we met or engaged, I've been following you for years. So keep up the good work yourself.
I appreciate it, Gus. It's been a pleasure, man.
Likewise.